improving access to global financial markets with cryptocurrency. I'm Tonya Hall for ZDNet and Tech Republic, and joining me is Bill Barhydte, founder and CEO of ABRA. Welcome, Bill.
Hi, Tonya. Pleasure to be here.
What does ABRA do?
ABRA is trying to be the WhatsApp for money, right? There is not a single app in the world for smartphones that allows consumers in every single country, right, to do in banking what we can do for messaging, right? So if I want to invest, if I want to send money, if I want to borrow, there's very specific apps in different countries like WePay in China, Venmo in the US, and Paysa in Kenya that can do bits and pieces of those functions, but there is no kind of one global banking app. ABRA is trying to be that app for the first time. We're starting with investing. We have users investing in different assets in our app in over 100 countries. Eventually, you'll see us focus on money transfer and credit and other banking services. But our goal when we launch a new feature is for it to be live globally. That's not always possible for legal reasons, but we try to get as global as we can with new app features. And that is something that I think ABRA is really the first company in history to have any success doing.
What are some of the most daunting financial problems that your app solves?
Well, the most important word I can use in terms of describing problems is access. So, meaning I want to invest in something and I don't have access, right? So in the early days of ABRA, we tested our platform. It's very technical how it works, which I'm happy to get into, but we tested our platform by giving people access to cryptocurrency and altcoin investing for the first time. And these are non-traders, meaning literally mom and pop style investors in the US or in South America, Asia, wherever. And that worked. They were investing in all kinds of different altcoins and cryptocurrencies for the first time. We recently announced that we've created a new product using the NASDAQ, where people in places like China and Indonesia, India, for the first time will be able to invest easily in US stocks. It's always been available to the uber rich in those countries, but not to the average retail investor. And so ABRA is trying to change that. So the operative word here is access, right? What's hard to access, and can ABRA make it easy to access?
You say that the single best use case for Bitcoin over the next 5 years is the collateralization of real world assets to facilitate banking. So give us an example of how that would work with a specific real world asset.
I'll give you a really simple example. I'm an Apple fanboy, so love Apple tech. So let's say I want to invest in Apple, but I want to invest $100 in Apple. So this collateralization example you're asking about actually solves two big problems. One, if I'm in a country like China and I want to invest in Apple, I can easily do that now with this model. And two, if I want to invest $100, which I normally can't do even in the US because Apple shares cost more than $100, I can actually get a fraction of a share somehow. So let's talk about how that works. So if I want to put $100 somehow into Apple shares, what our app is actually doing is, it looks to you like you're investing dollars, but what you're really doing is you're actually investing via Bitcoin. The app converts those dollars somehow magically into Bitcoin, and then uses those as the basis for investing in the Apple shares. So in other words, if the price of Apple goes up versus the dollar versus Bitcoin, you end up with more Bitcoin. And if the price of Apple versus the dollar versus Bitcoin goes down, you end up with less Bitcoin. And ABRA magically manages all of that in the background. And then we run a very sophisticated trading operation that says, okay, we don't want the consumer taking counterparty risk to ABRA, so make sure that you hedge away all that risk somehow magically in the background. And we've been doing that now for quite a while, and we've done like not over 9 figures of hedging transaction volume in our system to prove that it works. So the upshot of that is that if you're in China and you have access to a little bit of Bitcoin, which a lot of people do in China, you can put $100 worth of it into the ABRA app, and in less than 10 minutes, you now have exposure to Apple shares. And you don't even have to buy a whole share, you can buy 1/10 of a share. And that's what I mean by collateralization of real world assets. You're using the Bitcoin as collateral to get exposure to any other asset in the world that you may normally have a hard time accessing.
Cryptocurrency is notoriously volatile. How do you collateralize an asset over time when crypto can swing so wildly? I mean, how do you cover those wild swings?
That's part of what the magic of what we figured out. So there's two parts to building ABRA. There's the tech, and it's kind of like we call this smart contract platform. It's basically the contract that you're entering into from our app that gives you that price exposure to Apple in that example we talked about. And then the second part is the trading operation that actually hedges away that volatility risk that you're alluding to. So in other words, in the case of that Apple share, the consumer is collateralizing the contract by holding $100 worth of Bitcoin. And then the amount of Bitcoin adjusts itself. But last year, when the price of Bitcoin plummeted, that means we were giving lots of consumers Bitcoin all day long. Well, where did that Bitcoin come from? And why didn't ABRA go broke giving consumers tens of millions of dollars of Bitcoin? And the answer is the Bitcoin came from ABRA, but ABRA didn't go broke because on a dollar for dollar basis, we hedge away that risk on the open market at very low cost. And the money we make either on the hedging or in some cases on the spreads between currencies more than covers that cost of hedging away that counterparty risk. And we've actually published documents online. I gave a talk at MIT a few weeks ago, which you're more than happy to link to. It's about an hour talk that actually describes in detail how the hedging process works in concert with the smart contracts, but it works.
One of the cornerstones of legacy banks is that the deposits are backed in part by physical presence. The individual banking companies include real places, real people, and government regulations. Your app utilizes peer-to-peer transactions, and crypto ledgers are abstract, binary constructs on unreachable servers in the cloud. So what do you tell those who want to trust but retain a degree of crypto skepticism?
Well, I think there's three layers to the system that you're describing, both in the physical realm in the banking world and in this purely digital realm that I'm describing. In the physical realm, we have central banks who've proven that they are completely untrustworthy in terms of diluting the value of your assets. They will simply print more. My mom had a Mickey Mantle rookie card, right? Which was worth a lot of money. And if it was the only one in existence, it would be worth X. And if tomorrow she found that there was another one, in theory, it would be worth 50% of X. Now, that's logical to anybody who collects baseball cards. And in reality, it's no different with money. But for some strange reason, the public doesn't seem to really grasp that the same thing is going on with their money. That's part one. So layer two is you used, I don't remember the exact word you said, but you said part of your money is physically present at the bank, because the banks are at liberty to actually lend out the majority of their deposits, fractional reserve banking. Okay, and that means that if there is a run on banks, which we were very close to having in 2007, until we stepped in and forced Goldman and a bunch of other banks to actually take TARP money, which actually prevented a run on banks, according to everything I've understood and heard, right, would have been an epic collapse of our economy. Probably not just the US, but the entire global economy. So that idea of fractional reserve banking is basically what I would call a managed house of cards, right? Now, that managed house of cards has a lot of benefits, don't get me wrong, but it is a managed house of cards. And then the third layer is things like payments and, your Visa card, your MasterCard, your Venmo app. And those are apps which, generally in the West, we all know and trust, and we don't really know what goes on behind the scenes or how it works or why it works, but it just seems to work, okay? But when you really dig in underneath, it's a pretty shaky foundation that we accept at massive scale, especially if you look at things like quantitative easing. One of the slides I like to show in my presentations is, when I talk about hard money, is what happens in places like Venezuela and Argentina during hyperinflation. And the value of money being hyperinflated, or the circulation of money, looks like this. It's like a hockey stick. If you look at the same chart for QE 1, 2, and 3, the quantitative easing that we did after 2007, the banking crisis, it looks no different than what happened in Venezuela the last few years. Now, the difference is that the dollar is a global reserve currency, which gives it a certain value to many people that the Venezuelan bolivar will never have, okay? But if that erodes, look out, because we have nothing to fall back on except for the fact that the government forces you to pay your taxes in dollars. That's it at that point. So I think now back to the same equivalence in what I would call the Bitcoin standard. The Bitcoin standard, in my opinion, is the closest we've ever gotten to a real digital hard money since we left the gold standard. What I mean by that is, we know how much of it there will be at a maximum, right? 21 million. We know that it's divisible into tiny, tiny amounts out to 8 decimal places, which means if it's worth trillions of dollars, everybody can have it. We just won't talk about Bitcoin anymore. We'll talk about micro Bitcoins or Satoshis, okay, which are tiny, tiny pieces of Bitcoin. Okay? We know that you can build banking layer services on top, just like in the traditional banking world. You could do fractional reserve banking with Bitcoin. I don't know why you would do that, but you could. You can build lending services. You can build the collateralized asset models that ABRA does and has talked about. And you can even build second layer payment networks to do things like Venmo style micro payments. Maybe some of your audience have read about things like Lightning or Plasma in the Ethereum world that are trying to do these kind of layer 2 applications. So you have a similar stack. It's just that at scale, if you talk to young people, it's obvious to them that the crypto stack is a hell of a lot more stable and more interesting long term than the current banking stack. It's just a question of what's the path from here to here. And companies like ABRA are actually building those bridges to get from the old world to the new world by solving really interesting problems along the way, like collateralizing stocks so people in China and Russia and India and Indonesia can invest. So we, for the first time, have given people some visibility as to how we get from here to here. So hopefully that makes sense.
It does. Bill Barhydte, founder and CEO of ABRA. Very interesting stuff, Bill. If somebody wants to find out more about the work that you're doing and get involved or just have questions for you, how can they do that?
Sure. You can follow me on Twitter, Bill Barhydte, my first last name. You can go to abra.com to download and try out the ABRA app. And there's all kinds of really interesting stuff there on our blog site about how all this works, what's happening in the world of crypto banking, et cetera, et cetera.
Thanks again. And if you guys want to find more of my interviews, you can do that right here on ZDNet or Tech Republic, or go to my website, tonyahall.net. Thanks for watching.